After running JP Morgan for over 2 decades and surviving multiple financial crises, people constantly ask me, Jamie, what's the secret to thinking like a successful investor? But here's what really gets me fired up when someone in their 50s or 60s tells me they're playing it safe with their investments because they can't afford to take risks anymore. Let me tell you something that might shock you, that thinking could destroy your retirement. I'm Jamie Dimon, and I've been CEO of JP Morgan Chase since 2005. I've navigated this bank through the 2008 financial crisis, the European debt crisis, COVID-19, and every market meltdown in between. I've seen fortunes made and lost, watched brilliant people make catastrophic mistakes, and learned lessons that took decades to understand. What I've discovered over the years is that the biggest risk isn't losing money in a bad investment. It's not having enough money to maintain your independence and dignity in your later years. And the conventional wisdom about safe investing after 55, it's not just wrong, it's dangerous. Today, I want to share with you the risk intelligence framework that saved JP Morgan billions during the worst financial crisis since the Great Depression. More importantly, I want to show you how to apply the same thinking to secure your financial future, especially if you're over 55. The night that changed everything. Let me take you back to March 15th, 2008. It's 2 a.m., and I'm sitting in my office at 270 Park Avenue, staring at numbers that would terrify most CEOs. The fluorescent lights are humming, empty coffee cups are scattered across my desk, and my phone hasn't stopped ringing for hours. Bear Stearns, one of the most respected investment banks on Wall Street, a firm that had survived the Great Depression, 2 world wars, and countless market crashes, is about to collapse. Their stock has fallen 90% in just 2 days. Panic is spreading through the financial system like wildfire. My phone rings again. The Federal Reserve, Tim Geithner's voice is tense, urgent. They need JP Morgan to buy Bear Stearns immediately, and the entire global financial system is at risk. If Bear Stearns fails completely, it could trigger a domino effect that destroys banks, insurance companies, pension funds, and retirement accounts around the world. Every banker on Wall Street would have said no, too risky, too complicated, too much downside. The smart money was running for the exits, not jumping into the fire. But here's what I realized that night, sitting in my darkened office while the world's financial system teetered on the edge of collapse. Sometimes what appears to be the riskiest decision is actually the safest one in the long run. While everyone else saw catastrophic risk, I saw calculated opportunity. And that distinction between reckless gambling and intelligent risk-taking is exactly what you need to understand if you want to build and preserve wealth in your later years. My childhood lesson in risk. Before I go further, let me tell you about a lesson I learned when I was 12 years old that shaped everything about how I think about risk. My father took me to a casino in Atlantic City, not to gamble, it was 12, but to teach me something important. We stood at a blackjack table and watched for an hour. I saw people win and lose, get excited and devastated, make emotional decisions that cost them everything. Jamie, my father said as we walked away, gambling is when you risk money. You can't afford to lose on outcomes you can't control or predict. Investing is when you risk money you can afford to lose on outcomes you've studied and understand. That distinction has guided every major decision I've made since. During the 2008 crisis, buying Bear Stearns wasn't gambling, it was calculated risk-taking based on analysis, preparation, and understanding. While I believe your age is your secret weapon, here's something that drives me absolutely crazy about conventional financial advice for people over 55. Everyone tells you to get conservative, move to bonds, reduce your stock exposure, prepare for capital preservation mode. I call this a slow death approach to wealth management. Think about it. If you're 60 years old today, you could easily live until 95. That's 35 years of inflation, eating away your purchasing power. If you park your money in safe investments earning 3%, while inflation runs at 3%, you're not preserving anything. You're slowly going broke. Let me give you some real numbers that might shock you. In 1990, a postage stamp cost 25 cents. Today, it's 68 cents. That's a 172% increase over 34 years. If you had kept $100,000 in cash under your mattress in 1990, it would buy what $36,700 buys today. You'd have lost almost 2/3 of your purchasing power by being safe. During the 2008 crisis, I watched thousands of investors near retirement age make this exact mistake. They panicked, sold their stocks at the bottom in March 2009, moved everything to cash and CDs, and thought they were being prudent. What happened? They locked in massive losses and missed the entire recovery. From March 2009 to 2020, the S&P 500 returned over 400%. A $100,000 investment at the bottom became $500,000 by 2020. Those conservative investors missed it all because they confused safety with certainty. I remember visiting one of our private wealth clients in 2010, a 65-year-old retired engineer. He had sold everything in late 2008 and moved to CDs earning 1%. He was proud of himself for preserving capital. I had to show him that his safe strategy was guaranteeing he'd run out of money by age 80. The 3 levels of risk intelligence I've developed. Over my career, I've developed a 3-level framework for evaluating risk. And I believe this becomes even more critical as you get older because your margin for error decreases, but your need for intelligent risk-taking actually increases. Level 1, the obvious risk. This is what everyone sees. In 2008, everyone could see that buying Bear Stearns was risky. The bank was failing, markets were in chaos, public opinion would be brutal. For individual investors, obvious risks are things like investing in a single stock, putting all your money in one sector, or buying something you don't understand. Level 2, the hidden risk. This is what experienced leaders identify. I saw that not acting was actually riskier than acting. If Bear Stearns collapsed completely, it would trigger a domino effect that could destroy the entire financial system, including JP Morgan. For retirees, hidden risks include inflation eroding purchasing power, sequence of returns risk, or not having enough growth to fund a 30-year retirement. Level 3, the strategic risk. This is where true intelligence lies. I calculated that buying Bear Stearns at the right price would actually strengthen JP Morgan's position for decades to come. For individual investors, this means understanding that some apparent risks are actually opportunities in disguise. Let me show you exactly how this applies to your investment strategy. My Bear Stearns playbook for your portfolio. When the Fed called that night, I had less than 48 hours to make a decision that would affect not just JP Morgan, but the entire global economy. The process I use is the same one I recommend for any major investment decision. Step 1, calculate the worst case scenario. I locked myself in a conference room with our best analysts and asked, what if Bear Stearns is worth nothing? What if all their assets are toxic? What if this acquisition destroys JP Morgan? We modeled scenarios where we lost $50 billion, where we faced lawsuits for years, where our reputation was permanently damaged. For your portfolio, this means before buying any investment, calculate how much you could lose and confirm it won't derail your retirement plans. If losing the entire investment would force you to change your lifestyle, the position is too large. Step 2, identify the hidden value. Bear Stearns had incredible real estate in Manhattan, worth billions, a global client base built over 85 years, prime brokerage relationships, and thousands of talented employees. Even in bankruptcy, these assets had substantial value that the market was ignoring in its panic. For your investments, this means looking beyond current prices to understand intrinsic value and long-term potential. During the March 2020 COVID crash, airlines looked like disasters, but the underlying value of their route networks, landing slots, and customer loyalty programs remained intact. Step 3, negotiate protection. Here's the key. I didn't just buy Bear Stearns. At any price, under any terms, I negotiated hard. The Federal Reserve agreed to guarantee up to $29 billion of Bear Stearns' most toxic assets. This limited our downside while preserving unlimited upside. For individual investors, this means using diversification, position sizing, stop losses, and hedging strategies to manage your risk. Never go all in on anything, no matter how confident you feel. Step 4, move decisively when conditions are right. Once I had the protection in place and understood the risks, I acted quickly. We announced the deal that Sunday night before markets opened Monday. Speed was crucial because uncertainty was killing confidence in the entire financial system. In your investment life, this means being prepared to act when opportunities arise. Keep some cash available so you can buy during market panics. Don't try to time the bottom perfectly, but be ready to add to positions when quality assets go on sale. The result? We bought Bear Stearns for $2 per share, a company that had traded at $170 just a year earlier. We got their Manhattan headquarters alone for less than the building was worth. Today, that acquisition is considered one of the best strategic moves in banking history. The mistake that taught me everything. But I'm not perfect, and I want to share my biggest failure because it contains a crucial lesson for investors over 55. In 2012, JP Morgan lost over $6 billion on what became known as the London whale trades. Bruno Ixil, a trader in our London office, made massive, complex bets on corporate credit indices that went spectacularly wrong. I'll never forget the morning I found out about the losses. I was in my office, preparing for our quarterly earnings call, when my chief risk officer walked in with a look I'd never seen before. "Jamie," he said, "we have a problem." What followed were the worst months of my professional life. Congressional hearings where senators compared me to Bernie Madoff. Media coverage that questioned everything I'd built at JP Morgan. Shareholder meetings where I had to explain how we let this happen. But here's what I learned from that disaster. The mistake wasn't that we took risk. Banks must take intelligent risks to serve our customers and generate returns. The mistake was that we didn't fully understand the risk we were taking. The trades were too complex, too concentrated, and too removed from our core competencies. I had to testify before Congress, and Senator Elizabeth Warren asked me, "How can shareholders trust you to manage their money if you can't even manage your own risk?" It was a fair question, and it changed how I think about everything. This taught me something vital. The goal isn't to eliminate risk. It's to only take risks you completely understand and can quantify. This principle becomes even more important as you age because your ability to recover from major mistakes diminishes. The 3 questions I ask before every major decision. After the London whale incident, I institutionalized 3 questions that must be answered before JP Morgan makes any significant investment. I believe every investor over 55 should ask these same questions. Question 1, what's the worst case scenario and can we survive it? This isn't about being pessimistic, it's about being prepared. If you're considering a stock purchase, calculate how much you could lose if the company fails completely. If that loss would significantly impact your lifestyle or force you to delay retirement, the position is too large. I learned this lesson painfully in 2012. We thought our maximum loss in the London whale trades was $200 million. We were wrong by a factor of 30. Now, before any major position, we stress test our assumptions and model extreme scenarios. Question 2, what don't we know that we don't know? This is about intellectual humility. Markets are complex systems with countless variables. Are there hidden risks or dependencies you haven't considered? Have you stress tested your assumptions against different economic scenarios? When we bought Bear Stearns, we knew we didn't know everything about their positions. That's why we insisted on government guarantees for the toxic assets. We protected ourselves against our own ignorance. Question 3, how do we exit if we're wrong? Every investment should have a predetermined exit strategy, both for cutting losses and for taking profits. Hope is not a strategy, especially when you're managing retirement assets. I keep exit strategies for every major position JP Morgan holds. If our thesis changes, if new information emerges, if market conditions shift, we have predefined triggers for action. You should too. Why the conventional wisdom is dead wrong. Let me address the biggest misconception about investing after 55, that you should automatically become more conservative as you age. This advice made sense 50 years ago when people retired at 65 and died at 72, but today's reality is completely different. Life expectancies are longer, healthcare costs are higher, traditional pensions have disappeared, and Social Security replaces a smaller percentage of income. If you're 55 today and in good health, you need to plan for potentially 40 more years of life. That's longer than most people's entire careers. Your money needs to work that long too. Here's a story that illustrates this perfectly. In 1982, when I was just starting my career, I met Warren Buffett at a conference. He was 52 years old then. If he had followed conventional wisdom and gotten conservative with his investments because he was in his 50s, he would have missed decades of compound growth. Instead, he kept investing in businesses he understood, and his wealth grew exponentially over the next 40 years. The same principle applies to you. If you're 60 and healthy, you might have 35 years left. That's enough time for money invested wisely to grow substantially, even after accounting for withdrawals. My personal approach to retirement allocation. If I were retiring today, which I'm not planning to do anytime soon, here's exactly how I would structure my portfolio. This isn't theoretical advice. This is what I would actually do with my own money. 40% core holdings, blue chip dividend stocks, companies with sustainable competitive advantages, businesses I understand completely. Think Johnson & Johnson, which has increased its dividend for 61 consecutive years. Microsoft, which dominates business software. Apple, which has created one of the strongest ecosystems in business history. These aren't exciting stocks, but they're reliable wealth builders. J&D sells products people need in good times and bad. Microsoft's customers can't easily switch to competitors. Apple's customers are almost fanatically loyal. These companies will likely be stronger in 10 years than they are today. 30% income generation, a mix of high-quality corporate bonds, Treasury inflation-protected securities, TIPS, and perhaps some real estate investment trusts, REITs. This provides steady income and inflation protection. I focus on short to intermediate-term bonds to avoid interest rate risk, TIPS to protect against inflation, and REITs because people always need places to live and work, and rents tend to rise with inflation over time. 20% growth opportunities, exposure to innovation, technology, and demographic trends. Yes, even in retirement. Some of the biggest wealth creation happens during periods of major technological transition, and we're living through one right now. AI, robotics, biotechnology, renewable energy, these aren't speculative bets. They're the foundation of the next economy. I'd want exposure through diversified funds, not individual stock picks. 10% crisis preparation, cash, and short-term bonds. Not for daily expenses, but for opportunity. When markets crash, and they will crash, this money lets you buy at distressed prices instead of being forced to sell. This cash serves two purposes: psychological comfort, knowing you can pay bills during market volatility, and strategic opportunity, having dry powder to deploy when others are panicking. The sequence of returns solution that saved my clients. One of the most dangerous risks for retirees is something called sequence of returns risk. This is when you experience poor investment performance early in retirement, forcing you to sell assets at depressed prices to fund living expenses. I saw this destroy many portfolios in 2008. Retirees who had worked their entire lives suddenly saw their nest eggs cut in half just when they needed to start drawing income. Because they were withdrawing money during the decline, their portfolios never recovered even when markets rebounded. Let me tell you about one client who illustrates this perfectly. Sarah, a 65-year-old teacher, retired in December 2007 with $800,000 in her 401k. She planned to withdraw 4% annually or $32,000 to supplement her pension. Then 2008 hit. Her portfolio fell to $400,000, but she still needed $32,000 to live. Now she was withdrawing 8% of her remaining assets. Even when markets recovered, she never caught up because she had been forced to sell at the bottom. My solution? Build a cash bridge. Always maintain 2 - 3 years of living expenses in completely safe, liquid investments. This isn't dead money. It's insurance that allows you to keep the rest of your portfolio invested for growth during market downturns. If Sarah had kept $96,000, 3 years of expenses in cash, she wouldn't have needed to sell stocks during 2008 to 2009. Her remaining $704,000 could have stayed invested and participated in the recovery. By 2020, she would have been significantly wealthier. The demographic opportunity nobody talks about. Here's something most investors miss: the generation currently entering retirement controls an unprecedented amount of wealth. Baby boomers control roughly $70 trillion in assets globally. This isn't just a statistic, it's an investment opportunity. As this generation transitions from accumulation to consumption, entire industries are being reshaped. I've been positioning JP Morgan to benefit from this demographic shift, and individual investors should think the same way. Healthcare technology companies that help people age in place, senior housing operators with prime locations, pharmaceutical companies developing treatments for age-related diseases, consumer companies adapting products for older customers. These aren't just defensive investments. They're growth opportunities aligned with the most powerful demographic trend of our lifetime. The number of Americans over 65 will nearly double from 54 million today to 95 million by 2060. My inflation strategy for retirees. Let me be blunt about inflation. It's the silent killer of retirement portfolios. At just 3% annual inflation, your purchasing power gets cut in half every 23 years. For someone retiring at 65, this means their standard of living could be devastated by age 88. Most retirees completely underestimate this risk because inflation has been relatively low for the past several decades. But I've been managing money long enough to remember the 1970s and early 1980s, when inflation reached double digits. Gas lines, price controls, economic chaos. Here's what I learned during those years. My hedge against inflation isn't gold or commodities. It's owning pieces of businesses that can raise prices. companies with strong brands, loyal customers, and pricing power. These businesses don't just survive inflation, they thrive during it. Coca-Cola can raise prices when costs increase. Microsoft can increase subscription fees. Johnson & Johnson can charge more for essential medications. These companies have what economists call pricing power, the ability to maintain profit margins even when input costs rise. Bonds, on the other hand, are sitting ducks for inflation. If you lend money at 4% and inflation jumps to 6%, you're losing 2% annually in real terms. This is why I recommend tips for the bond portion of retirement portfolios. They adjust with inflation automatically. The psychology of successful long-term investing. After nearly 50 years in finance, I've learned that successful investing is more about psychology than analysis. The numbers matter, but your emotional discipline matters more. Here's what I've observed. The investors who do best over time aren't necessarily the smartest ones. They're the most patient ones. They're the ones who can ignore short-term volatility and focus on long-term value creation. This psychological advantage actually increases with age and experience. You've lived through market cycles before. You remember the tech bubble bursting in 2000. You lived through 2008. You've seen crashes and recoveries. You understand that temporary setbacks don't determine permanent outcomes. Use this experience to your advantage. When younger investors are panicking about market volatility, you can remain calm and rational. When they're chasing hot trends and meme stocks, you can focus on time-tested principles and proven business models. I remember during the dot-com bubble, young analysts at JP Morgan were telling me I was missing the new economy. Companies with no profits were worth billions. Traditional metrics didn't matter anymore. Everything was different this time. I'd lived through enough cycles to know that fundamentals always matter eventually. Sure enough, when the bubble burst, companies with real profits and real business models survived. The rest disappeared. Crisis preparation as wealth creation. I want to share something that might sound counterintuitive. I'm always preparing for the next crisis. Not because I'm pessimistic, but because crises create the best investment opportunities. The March 2020 COVID crash is a perfect example. Investors who maintained cash reserves could buy blue chip stocks at prices we hadn't seen since 2009. Apple fell 30%. Microsoft dropped 35%. Amazon declined 25%. All were available at massive discounts for about 6 weeks. Those who were fully invested or who panicked and sold missed this opportunity entirely. But those who were prepared, who had maintained dry powder specifically for moments like this, could act decisively while others were paralyzed by fear. This is why I recommend the 10% cash allocation. It's not earning much return sitting there, but it gives you the ability to be opportunistic when others are fearful. As Warren Buffett says, be fearful when others are greedy, and greedy when others are fearful. I keep crisis preparation funds for JP Morgan for exactly this reason. In 2020, while other banks were cutting lending and hoarding cash, we were able to extend credit lines to corporate clients who needed liquidity. We gained market share and strengthened client relationships while competitors retreated. The estate planning multiplier. Here's something most financial advisors miss. When working with clients over 55, estate planning considerations can actually justify higher risk tolerance, not lower. If you're fortunate enough to have more assets than you'll spend in retirement, the excess money has a different risk profile. That money is effectively investing for your heirs' benefit, which means it has a much longer time horizon than your personal spending needs. At JP Morgan, we think in centuries, not quarters. We've been around for over 200 years and plan to be around for another 200. This long-term perspective allows us to take risks that quarterly focused competitors cannot. You can apply the same logic. Money you don't need to spend might justify more aggressive growth strategies than money earmarked for essential expenses. If you have $2 million but only need $1 million for retirement, that extra $1 million can be invested with your children's or grandchildren's time horizon in mind. Why I still love America despite everything. Despite all the challenges we face, political polarization, massive debt levels, social tensions, infrastructure problems, I remain incredibly bullish on America's long-term prospects. And this optimism shapes how I think about retirement investing. We have the world's best universities training the next generation of innovators. We have the most dynamic entrepreneurial culture where a kid in a garage can build $1 billion company. We have the deepest, most liquid capital markets that fund innovation better than anywhere else. We have the strongest rule of law protecting property rights and contracts. Most importantly, we have a track record. We've overcome bigger challenges than what we face today. Civil War, 2 world wars, the Great Depression, the Cold War, multiple financial crises, terrorist attacks, pandemics. Every time America has emerged stronger. Every time long-term investors who stayed the course were rewarded. Every time the pessimists who sold and moved to cash or gold were left behind. I see no reason why this pattern would change now. Yes, we have problems. Yes, we face challenges, but we also have incredible advantages and a proven ability to adapt and overcome. This is why I believe maintaining significant equity exposure throughout retirement makes sense. You're not just betting on individual companies, you're betting on American innovation, entrepreneurship, and resilience. The compound interest revelation that changed my perspective. Let me challenge something you've probably heard countless times, that you don't have enough years left for compound interest to work. This is mathematical nonsense, and it's preventing people from building the wealth they need for retirement. If you're 60 years old today, you potentially have 35 years remaining. At a 7% annual return, money doubles every 10 years. So $100,000 becomes $200,000 at age 70, $400,000 at age 80, $800,000 at age 90. Even at age 70, you might have 25 years, enough time for money to quadruple at reasonable return rates. The real power of compound interest isn't just about time, it's about consistency and not interrupting the process. The biggest killer of compound returns isn't poor investment selection, it's panic selling during downturns. I learned this lesson early in my career. In 1987, I was a young executive at American Express when the stock market crashed 22% in a single day, Black Monday. Many investors panicked and sold everything thinking the world was ending. But those who stayed invested were rewarded. The market recovered within 2 years and went on to new highs. The panic sellers locked in permanent losses and missed the entire recovery. My final advice for the 55-plus investor, as I think about the investors who have been most successful over the decades I've been in this business, they share certain characteristics that you can adopt regardless of your age or wealth level. They think long-term. They don't get distracted by daily market noise or cable news hysteria. They focus on the fundamental value of what they own and trust that markets eventually reflect reality. They stay disciplined during volatile periods. They don't panic sell during crashes or euphoria, buy during bubbles. They stick to their allocation plan and rebalance mechanically. They focus on what they can control rather than worrying about what they cannot. They can't control market returns, but they can control costs, taxes, and asset allocation. They can't control politics, but they can control their savings rate and spending discipline. Most importantly, they understand that successful investing after 55 isn't about playing defense, it's about playing smart offense. It's about taking calculated risks that position you for long-term success rather than avoiding all risk and guaranteeing long-term failure. The goal isn't just to preserve what you have, it's to ensure that what you have can preserve your independence, dignity, and ability to help the people you care about for the rest of your life. That's risk intelligence. That's thinking like a successful investor. And that's how you turn the challenge of retirement planning into the opportunity of a lifetime. Remember, the biggest risk in retirement isn't losing money in the market. The biggest risk is not having enough money to live with dignity and independence for potentially 30 or 40 years. Sometimes what feels safe is actually dangerous, and what feels risky is actually prudent. Trust your experience, use your wisdom, and don't let fear rob you of the financial future you've earned.